All right, this video compares the financial leverage and profitability ratios for McDonald's and Johnson & Johnson over the period 2012-2016 based on the financial statements discussed in the prior videos. All right, financial leverage. McDonald's really leaps out because their financial leverage has increased so much over the last few years, and they now have currently negative shareholders' equity, which is unusual. If we see that the assets have actually gone from about 35 billion and dropped to 31 billion, and the total liabilities have increased from 20 billion to 33 billion. The company has been borrowing a lot of money, all right, and buying back a lot of shares of stock. All right, so they're actually trading debt for equity, and they currently have negative shareholders' equity. Very uncommon, especially for firms this size. Try and remember, though, that when we look at the historic value of common stock and paid-in capital and retained earnings, those are recorded at the values at the time. Retained earnings have gone from 39 billion to 46 billion, so that's an increase of about $7 billion. That's in current dollars, but where that $39 billion of retained earnings as of the end of 2012, that's since the beginning of time for McDonald's minus any of the dividends. So these are historic numbers. When they're buying back shares of stock, they took off $11 billion they added $11 billion to the Treasury in 2016 alone, so that's in current dollars. So while you usually don't see negative equity, in this instance the main driver of the negative equity is that they're buying back shares of stock at current price, and where are they getting the money for it? A whole lot of it is coming from borrowed money, so swapping a lot of debt for equity. And the result is that the debt ratio actually is greater than 1. So at 107%, that means 107% of total liabilities for every 100% of assets. So $1.07 of debt for every dollar of assets. And that's unusual. Johnson & Johnson, much more conservative, about 50-50 debt and equity, and they're buying back shares of stock too. What happens when you over leverage like this? The equity multiplier is meaningless now because you have negative shareholders' equity, and things like the debt to capital ratio, they become meaningless as well. So if we look at times interest earned, that's measuring how many dollars of operating income they have to pay the interest, and cash coverage is a broader measure where it looks at the operating income plus add back the non-cash expenses like depreciation. They still have plenty of money to service the debt, but Johnson & Johnson obviously much better coverage ratios than the folks over at McDonald's. If we move down to the profitability ratio, basic earnings power is operating income per dollar of assets, and McDonald's has an edge there. When we get to the return on assets, they tend to have a higher return on assets than Johnson & Johnson. Again, the return on equity becomes meaningless because of the high degree of leverage. Gross profit margin, McDonald's gross profit margin, that's sales less cost of goods sold. That gives you a 40% margin, and over at Johnson & Johnson is 70% margin. That's the money left over. So we can see that the operating profit is almost identical for the two, around high 20s, almost 30%. So the difference is that McDonald's has a relatively high cost of goods sold and low selling, general, and admin, and Johnson & Johnson has relatively low cost of goods sold and relatively high selling, general, and admin. The net profit margin are similar, but in this case, Johnson & Johnson edges them out at low 20s compared to McDonald's just a shade under 20%. We also see that McDonald's had a couple of years where that dipped and then they seem to be on a recovery. The news stories also discuss that. If we look at free cash flow, and free cash flow is cash flow from operating activities from the cash flow statement, less the expenditures on property, plant, and equipment, this gives you a slightly different measure. The net income is based on accounting numbers. Free cash flow is based on dollar bills in and out. We can see that the free cash flow per dollar of sales seems to be better over at Johnson & Johnson, so that's the equivalent of the net profit margin. And then the free cash flow per dollar of assets is more even, and in recent years McDonald's actually has an edge. That's because their assets are declining while their free cash flow is actually improving. If we go back to the financial statements, the abbreviated cash flow statement, we can see that cash flow from operating activities at McDonald's is between $6 and $7 billion. Take away the CapEx, and the CapEx has actually been declining. So when we get down here to the free cash flow, it's actually slightly increasing, up from a base of about $4 billion. Now it's $4.3 billion. And Johnson & Johnson's free cash flow has been increasing, but it's materially higher. But when we compare that, the free cash flow per dollar of assets, the assets at McDonald's are going down from 35 billion, 36, 34, 37, now to 31 in this latest year. So that's where we see changes in the free cash flow per dollar of assets. The free cash flow is increasing, the assets are starting to decrease at McDonald's. Johnson & Johnson has so many assets relative to Mickey D's that that's why you see these being comparable numbers. Even though J&J has much more free cash flow, they also have 4 times as many assets. And then if we take this to the logical conclusion of looking at Dupont analysis, it's very hard to do a comparison of Dupont analysis between these companies because of the negative equity. So the return on equity is almost a meaningless number in this latest year for McDonald's. For Johnson & Johnson, not so much. But we see that the profitability, if you stop at return on assets, we can see that while McDonald's has slightly less net profit margin, they have a higher total asset turnover, sales per dollar of asset, and that gives them the edge in return on assets. So that gives you some idea of the profitability and financial leverage measures for these two firms.